Hi traders, this is Stacey Burke from Stacey Burke Trading. Today we're going to be talking about the opening range and using the monthly ATR and the opening range to look at high probability opportunities when trading the Forex market. So I'm just going to go over the last few months of the pound yen, and you can take this information and go and do your own testing, but it comes back to our rule about the 80% of the time in market profile, the initial two time frames in 80% of the situations have a high probability of forming a high or low for that trading session. Now in the way that I look at the markets on the daily charts, but over the monthly time frame, is that your highest probability situations for when the market is going to give you an opportunity to possibly have a low risk, high reward opportunity are at the beginning of the month or midway through the month. Now that can mean sometimes re-entering a trend, that can sometimes be looking at a reversal, and that may be sometimes just looking at a range trade. Now there's two types of bars, and that's a trend bar and a doji. And the market will often, if you look at a monthly chart, it has the exact same types of appearance as it does on a daily time frame. So you can see that these dotted lines in this particular case on the monthly chart are the yearly period separators, and then when we go back to the daily time frame, we have the monthly separators. So I'm just going to mark off the first couple bars of the month at each of these months, the high and the low of that initial balance. And as you can see, we initially had a sell signal come in at the top of that second bar, and then we had a buy signal come in at the bottom of that first bar of the month. Now again, looking to your left for market structure, we could see that the market was making higher highs and higher lows, but I'm just going to give you some really simple indications of where we can look for high probability changes in direction or continuations with the market. So in this particular case, indeed, the first bar of the month did form a buying extreme for the first half of the month. The selling that set up after the second bar became a temporary top, but it did give early sellers an opportunity to short that market and then resume back long again. But just keeping it simple, we'll look at the high and the low for the first and second bars as our initial balance. So aggressive bears had the opportunity to get in up top. More conservative sellers or people who wanted to add a second position could have done so here at the break of the low of the second bar, which again, just coming back, we see that the market had made some lower lows and lower highs at that point. So again, we go to the next month, and this is a really great example of where the market was breaking out strongly, and that first bar, again, the rule is 80% of the time the market will form a high or low on that first or second bar that has a high probability presence of holding as a buying or selling extreme for the month. So we see that breakout traders entered the market here, and that market continued to sell short. Now, if you were trading that market, I'm waiting for both bars. In this particular case, the reason why that market, you could have entered that short, is that the market broke out on the second bar. So if you hadn't traded the breakout, you certainly could short it there, because you've got a high probability that that market is going to continue down, and our 80% rule says that 80% of the time, the higher the low of that initial balance has a high probability of holding for the month as one of the extremes. Now, people could say, well, how do you know that the low of the second bar isn't going to be the low for the month? You don't know, which is why you would place your stop above that bar. But in this particular case, we've got a very strongly selling off market. We want to be able to enter that trade with confidence that we're trading with the trend. And in this case, we're making lower highs and lower lows day after day. So if we go to the next month, okay, we've got the high and the low. We've got an inside bar as our second bar of the month. So people who traded the break of that inside bar, had a nice trade short. And again, one of the things we want to look at with structure to the left side is even if you project those the highs of those initial balance, you see that again we have a lot of selling off occurring above this market, and what we're witnessing in this particular case is a three-legged pullback. Three legs are often what you'll see against a strong trend. So again, as I'm just trying to highlight some examples, you take this information, go back, do your own homework, do your own research, back test it, come up with a system that you're confident trading, but I'm just giving you some high probability opportunities to witness where the market may change direction, continue with the trend, or go into a range. So again, if we count the bars here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 bars forms our mid-move. There's 22 bars, roughly 20 to 22 bars in the month. You can count them yourself, but we look for possibly a resume of a strong move halfway through the month. So we go to the next month. We've got our high and our low setting up. We'll use the darker one here. So we've got our high and our low. Now in this particular case, we do have a downward trending market. The market has made it appear that it's going to form a top and possibly catch short sellers resuming that trend. That didn't happen. The market continued to break out. Now if you didn't trade the break of that high, you certainly could go long on a limit order of the high of the second bar. Okay, and again, your stop could be below the low of that second bar, and if our 80% rule premise holds tight, one of those highs or lows has a high probability of holding as an extreme for the large part of the month. In this particular case, the market did retest, but it didn't test the stop of the low of the second bar, and it gave us an opportunity to catch a small swing long again. So into the month April right now, we see very strong bear bar to open it up, taking out the lows of the previous month. Very weak doji. And again, if you shorted the doji, feeling confident, you could limit order the low of the first bar. Your stop again is either 1R, 1 ATR 20, whatever you want to use. But again, we've got a low risk, high probability trade. Look at your monthly ATRs. Get an idea of the instrument that you're trading, of how much the monthly range has of moving. Look at your structure on the left-hand side of the market. Look for the high probability, low risk opportunities to enter with the trend. When you get momentum, remember you've got trend bars and dojis, but look for momentum. These are momentum trades in a lot of the cases, and oftentimes you'll see a real small one-bar pullback and then a resumption of the trend. Hopefully you got some value out of this today, traders. Really simple price action trading, looking at high probability opportunities to enter the market, and keep it simple. If you like it, please share it on Facebook. Stay disciplined, stay focused. With all these trades, just on this, you can see that one bar is pretty much all the risk you need. You're looking for the evidence of the institution leaving its footprint. Follow the smart money. Thanks, traders. Hi, traders. It's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.